Okay, hello everyone. My name is Vikas Agrawal and I'm the founder of AIF and PMS Experts India. As all of you know that at AIF and PMS Experts India, we keep organizing these knowledge-based sessions. So we thought, why not we'll invite somebody from Tata Mutual Fund this time and record the session. So with me I have Mr. Anand Vardarajan. Anandji, first of all, thank you so much for accepting our request and taking the time out from your busy schedule and agreed to record the session with us for our investors.
Pleasure's mine. Thank you. Thank you for inviting.
Thank you. So, the idea is we thought why not we'll talk about something which is very, very interesting and we see good amount of value migration happening in that area. Today we thought we'll talk about long short funds. Well, most of the investors on the mutual fund side, they're very much aware if they have money for the short term or if they have money maybe for 1 year to 3 years time frame. They look at various options and explore. For example, they look at arbitrage fund, they look at hybrid equity fund. But lot of things are happening on the AIF side as well. A lot of innovations are taking place on the product side. So Anand is with us. Anand brings about almost 2 decades of experience on the table, both on the distribution side as well as on the product development side. At Tata, he heads the business and he also heads the product team. So we thought we'll try and read his mind today, try and understand how does the long short fund works, and what sort of investors should be looking at these sort of offerings. So these are 2-3 things that we want to talk about. As we move ahead, there will be more questions. Anand, my first personal question, and this is nothing to do with the topic here. You spend good amount of time heading ICICI Wealth team, and then you coming on the other side of the table, and now you're a manufacturer by yourself. So firstly, what made you to come this side, and how has been your experience so far?
So I really think I keep saying this very often. This is really just like a cricket stadium. It's the same pitch, it's the same players and the same rules roughly. And I don't know if you remember. I think way back in the 80s or so, in cricket you would have only 2 cameras. Or maybe just 1 camera, one which was placed, and you would see the keeper end once and you would see the bowler end up.
Right, I remember.
Alternate overs. Correct. That's how you would see it. I really think this is one of those instances where I have been on one side looking at it from a distributor perspective.
Sure.
And I exactly empathize, perhaps have some understanding of what clients seek, what the challenges distributors face. And when I crossed over to the manufacturing side, I think it's that much more easier for us to empathize, understand, and create product solutions which solve the problems of what an end customer or a distributor will be really looking for. So I don't see this as a different industry move. It is just camera change.
Well said. Great. Obviously, when you interact with clients, you tend to develop some sort of understanding, and then becoming a manufacturer, you sort of understand what kind of behavior do they bring on the table, and based on that you can create various offerings. So great.
And also I think distributors provide solution, manufacturers provide products.
Yeah.
And if you can build a beautiful bridge between products and solution, and you can weave that together, I think it just adds value to the end investor.
Right, great. So now coming back to topic, so as I said that this long short category, if you look at the developed economies, this is one of the largest category. But in India, of course, SEBI, played very, very important role. The regulator is like a father of the industry. Ever since they have structured this, organized this under the category 3 option of AIF, it is shaping up well. But my sense is that, it will become one of the largest. I don't know, maybe you can share your opinion here. So I would request you, there are a lot of investors who are not even aware or familiar with this concept. So if you can just talk to them and tell us what is this long short category, and within long short category there are enhanced and they are absolute. So what are these 2 options?
So first is let's start from the basics. I mean, if you have a portfolio and your investors invest, you will make money only when your underlying value starts going up, and you are right on those picks. So what you bought has to be right, and they have to go up. That is when you would make money.
Right.
Markets do not always go up in one direction. There could be times that it could be flat. There could be times it could be lower, or could be you could be in a bear market also.
Right.
So like there is this joke that there are, you have only two types of how do I say, portfolios. One, bull market portfolio, and waiting for a bull market portfolio.
Yes.
It cannot work that way. There will be, market has its own mind. You will have ups and downs, and you capture the upside. You could also be in a position where you can call out, and if you think there's an opportunity that market could go down, then obviously you should have some instrument which will benefit out of that downside also. What long short fund does is exactly that. Think of it just like a mutual fund portfolio. What do you do in a mutual fund? You have a benchmark, and you have overweights and underweights. So you will have sector allocations, and then you will have stock allocations.
Right.
So when you do sector allocations, you will have overweight sectors. So benchmark will have A, B, C, D sectors, and you will have overweight sectors, and you will have underweight sectors. Let's put that in AIF terms. Overweight sectors are your long positions. Underweight could be your short positions.
Right.
Where you express a view that they are fundamentally weak, structurally or cyclically they're looking weak, and you go and short them. And if you're right, you make money on that. And if you are right on your longs as well as on your shorts, and there's money to be made on both sides of the table. That's what AIF products are all about. And within that, what you have is aggressive, very aggressive, not so aggressive, conservative, and so on. So that is what you mean by when you said enhanced and absolute and so on. So what the AIF space tries to solve is exactly this problem, that you have. Let's look at all the types of products that you have. You have passives. What problems do passives solve? They are market hugging products. You don't try to beat the index. You don't want to underperform the index. What is the best thing you can do? You hug the index.
Be in line with
passive.
Yeah.
Then you have alpha strategies, which are typically your mutual fund PMS, which try to give you alpha out of it. Then you say that you want to have market neutral products, which are basically, you don't know whether market goes up or down. You're trying to solve a problem, saying, can I get a neutralish experience irrespective of market is up or down? Can I get a neutral experience? So some of those combinations can get created using long short strategies. So you can have market neutral, you can have enhanced equities, and so on, but by taking much lower risk. So typically, I think as people, I think there is a misunderstanding often that a hedge fund would mean you're taking more risk. Hedge actually reduces the risk and tries to give you market-like returns. That's what it is supposed to be doing. And you make money by expressing your view on both sides, which is on the long side as well as on the short side.
Sure. In fact, just to add, these AIFs, long shorts, generally what happens that suppose somebody is a HNI client or ultra HNI client having a portfolio of 10, 15, 20 crores. Either he's bullish or he's bearish. So either he's investing in long strategy and waiting for markets to do well, or he's redeeming. But I would say that when I look at from my eyes as a wealth management outfit, I would say that it deserves some amount of allocation as a separate allocation, that this much money should be in long short any point of time, which continues to create consistently some amount of alpha, which is very important from a portfolio point of view. The other thing is what I wanted to also talk about is there are a lot of perception about this fund in the markets that it can really deliver negative returns and how it is a hedge. So can you throw some more lights on what should be the ideally realistic expectation for the investor to expect returns? I'm saying the absolute one, and also the other one, and what can go wrong, how much money they can lose vis-a-vis the long only.
See, I really think as far as long only funds are concerned, long only funds will do well when the stocks that you picked, move up.
Right.
Either that has to happen, or you will have to be in a systemically uptrending market. That's when your long only portfolio will do well. In a long short fund, I think when you look at, you will always in all market, whether even in the fiercest of bear market or fiercest of bull market, you will find some stocks which will always underperform, or which could be negative even in the fiercest of bull market.
Right.
And some stocks will always be up even in the fiercest of bear market. So what you need to do is just identify, if you're getting some of those opportunities and identify the stocks correctly, then it becomes very easy for you to construct that kind of a portfolio.
Right.
Now coming to AIF and the misconception that you spoke about, that people have, that can it be negative? What problem? First thing, the question we need to ask is, why should you buy, or why should you look at long short?
Right.
I think the reason to look at long short is, what we specifically do in our strategy is very clear. We are saying that, everyone knows that equity over long periods give you high return.
Right.
But nobody likes the volatility which comes along with equity.
Correct.
Everybody likes the stability of fixed income, but not many like the low returns that come along with it.
Right.
Is there a way you can resolve the conundrum by saying equity से थोड़ा सा volatility कम कर दिया and fixed income में थोड़ा सा return बढ़ा दिया? Then what kind of outcome can you create? So I am not for a minute saying that it is a fixed income product,
Right.
that you get positive returns every month, but significantly lower volatility than equity, and much better return than fixed income. Like for instance, I think the fund that we are running in our equity plus absolute, I think the idea is very clear. What we run there is a 25% equity exposure product. Net 25% is our equity exposure.
25% long.
So essentially, if you put a gun to my head, I would say it is very similar to an equity savings fund. If I were to give you a close comparison from the mutual fund point of view, किसी को बताना होगा कि what does it do, then I can say that equity savings fund आपको समझ में आता है, तो it is exactly that. At heart, it is like that in terms of risk profile. It's 25% long. This is also 25% long. How we construct that is, we have a very thin, long-tailed portfolio of many stocks, and we have a very small net equity exposure. So the thin, long-tailed portfolio ensures that no stock really wags the dog. No stock, no matter how good it does or how badly it does, hurts you or helps you too much.
Right.
At the same time, because your net exposure is very small, if there is a market-wide problem, you still get exposed only to 25%.
So downside is well protected.
Correct. And because you are spreading your portfolio across longs as well as shorts, some shorts will work out, some won't. Some long will work out, some won't. And it's not that you need a great many stock which has to do well. In balance, if roughly half of your portfolio does, is headed in the right direction, you will end up making decent return. The promise that you have to look at is really only about what we endeavor to do. Promise could be a wrong word, but what we endeavor to do is something where we want to dial down volatility it could possibly be the lowest risk equity product that you will have in your portfolio.
Sure.
Just like an equity savings fund would also be the lowest risk equity product. What do you do there? You get slightly better return than fixed income, and very, very low risk as far as equity is concerned. That's the thing that we are trying to do here. That having done, I keep saying very simply put, I think because of the way the strategy has worked out, we've been able to deliver very good returns over the last 30 months or so. While it's a reasonably, in 30 months we've seen all types of phases.
Markets,
We've seen a very sharp correction followed by a very sharp rise, followed by a nothing, dwindling, drifting upward here, and post-war we've seen again a sharp dip and so on. So I really think like Vladimir Lenin said that there are decades when nothing happens and there are days when decades happen. We've seen all of that in the last 3 years.
Last 30 months,
So in that context, when you look at it, we've been able to deliver almost Nifty-like returns despite being 25% equity product only. So which is, figuratively speaking, a simple moped engine and a sedan car delivery in terms of output. If you were to look at it, with 25% engine power, you are almost delivering like what a sedan will deliver, because you've delivered Nifty return with a 25% exposure.
Okay, so you are in line with the benchmark.
Almost. While Nifty is
I mean, the
not
benchmark is so. As
no,
in the
benchmark
Nifty,
is not
the
Nifty.
benchmark is not Nifty.
Benchmark is not Nifty, but we've been able to even beat Nifty, because if you fall lesser than Nifty, if you fall fewer times than Nifty, if you're negative much fewer times, so Nifty has had 12 negative months, we've had 5 negative months, and the magnitude of our negativeness is much lower than Nifty, then the upside will take, if you take care of downsides, upsides will take care of themselves itself.
Great, and very interesting. And so the other thing is, within the framework, you have in category 3, and then within the category 3 you are allowed to take some leverage positions. So I really want you to discuss with our investors that how much leverage can be created and what can go wrong, what is the downside risk here.
So category 3, you can say, from a regulation point of view, you can go up to 2x,
right?
Which means on a 100 rupee portfolio, you can take 100 rupees of additional exposure.
True.
What we do is, roughly about 50% on an average, 55% will go into cash equities, 45% would be fixed income, and we create a 60% derivative exposure, which is a net short portfolio.
Right.
That when you combine with our cash equity, you will end up having something like a 25% net exposure. That's really the rough breakup.
Sure.
So the correct way to think about it is really, X of fixed income, it's a 110, 115 kind of a gross exposure and a 25% net exposure.
And within the 60% of the derivative exposure that you've created, what would be, how much it would be hedged?
So we don't do perfect hedges. We'll have imperfect hedge, because if you create perfect hedge, it becomes an arbitrage product. This is not an arbitrage product.
Sure.
So we create imperfect hedge, and you will have roughly 40-45% would be short and 15% would be long. So you'll have a minus 30 number there in derivatives, and when you offset that against your 50-55 of cash equity, you'll arrive at a net number of 20-25 net long.
I got that. Okay, great. So maybe last question. So can you also please throw some lights on taxation aspect? Because category 3, knowing the fact that all the taxes are paid at the instrument level here. So how different it is? Within the category 3, you have long only and you have long short both. So since we are talking about long short, how is the taxation? A, and B is investor, do they get what? They get an audited statement in their hand at the end of the year, and how do they give it to their chartered accountant so that they don't have to pay any tax?
So I think category 3 taxation, it is treated because it is a trust which is investing the money, and trust is seen as an association of persons. and hence
Right.
individual income tax becomes applicable there.
Right.
The same rates become applicable. What we've done here is a dual portfolio approach, which means your equity portion, especially the cash portion, will be gets treated as capital gains, and the other portion, the derivative portion, all of that will get treated as business income.
Sure.
So blended taxation is what would apply here, and tax is paid at a trust level, at a scheme level itself. So the investor would get tax paid
Returns. Yeah.
In the hands of the investor. It will be tax paid, and we would pay tax in the capacity of representative SSE. So as a representative SSE, we pay tax on behalf of the investor.
So do they get some sort of certification which they can?
So I mean, when in our statements, I think it's a self-explanatory, very simple, very lucid statement we give, where we give a breakup of.
So investor can pick up that and give it to their
Whatever
chartered
they need to know. I think they'll be having more than sufficient information on tax paid, on cost, etc. So
Right.
self-explanatory.
Great. So before we conclude, last question, Anand. So where do you see this category as a whole? Both the category, as in within that you have absolute and then you have sort of long only enhanced positions as well. So where do you see this industry going?
Currently, the category is about roughly 15,000 crores, the long short category. Totally, AIF Cat 1, 2, 3 put together would be roughly 7 lakh crores, give or take, and this is only about 15,000 crores. Cat 3, if you were to look at it, would be roughly about 70,000-80,000 crores.
Yeah, 65 is your long only and 15 is so around 80,000.
Yeah, so 15 is long short. We really think as investors start getting exposed to this idea, because it's very unique. It is, the most important thing at the heart of long short is, the whole market sensitivity which is there to your portfolio keeps getting disconnected. You do not think, I think the premise of this type of product is really to not be market direction dependent to get your return.
Right.
So the less you are direction dependent, you have your own mind, and your portfolio has an independent way of looking at it. That's why it's called an absolute return fund, or that's why it becomes a market neutral or absolute nature of the fund it derives from. So essentially we really believe that more and more investors are getting into it. They're having reasonably good experience and coming back asking for more, and it just gives a lot more variety in investor portfolio, because think about it, how much more long only will you do, and you need something where you got to also prepare for times when markets do not do well, and then where do you hide?
Right.
This becomes a very credible substitute.
I think well said. This clearly indicates that there is this separate positioning altogether, and there is a separate allocation which needs to be made in this category, because
Absolutely.
As we grow and become more mature, because initially mutual fund to sahi hai, people started with mutual fund. What I observe, because I keep talking to a lot of investors, I really see a lot of maturity. Investors have become more mature as we move ahead. I think most of the HNI investors are also looking at a category like this.
Please do remember, even when mutual funds started investor awareness, mutual funds were subject to market risk was the first.
Right.
And now mutual funds has come. I really think that's the transition which I'm very hopeful of for
the AIF and PMS industry as well.
That whole subject to market risk and mutual funds is a journey that we've traversed.
Right.
And now it's becoming household name, and I think it will be the same for AIFs also as we fast forward.
Right. All right. So with that, we'll conclude the session here. It was great interacting with Anand. Really got a lot of insights. One disclaimer before we conclude. So all the discussion that we had is only for the education purpose. It's not a recommendation at all. If you want to invest, you can speak to our experts team at aifpms.com, and they will understand your risk appetite before they recommend anything to you. So thank you so much, Anand.
Thank you for the opportunity.
It's a pleasure
Likewise.
interacting with you.
Thank